The purpose of Wealth Talk is to educate, inform, and hopefully entertain you on the subject of building your wealth. WealthBuilders recommends you should always take independent financial, tax, or legal advice before making any decisions around your finances.
Welcome to episode 126 of Wealth Talk. My name is Christian Rodwell, the Membership Director for WealthBuilders, and I'm joined today by our founder, Mr. Kevin Whelan.
Chris, we're doing it the old-fashioned way.
Face to face.
Yeah, we're sitting in the office in the farm in Sussex, and we're having a bit of a business meeting today, and we're having a little chat now. We thought we'd do a podcast. We've got a little bit of time left over at the end of the day.
We've got the hardware out to record, and this takes us back to the early days. But today we are paying attention to something that we should be checking regularly, and I certainly do, and that's our credit score, Kevin. When was the last time you had a look at yours?
Well, Chris, I think, I'm a net lender. I lend my money. I don't borrow very much, so I don't really pay too much attention. But look, it's a serious subject, because if you're looking to build your wealth, almost everybody will build their wealth through some form of leverage. And we've talked about leverage before in many episodes of Wealth Talk, and including in the 9-step roadmap as well, with step
5.
It's been a long day, Chris. So the whole concept of leverage is making more for less. If you can find that you can borrow money from somebody at a lower rate, and then you can get a higher ROI. So you get a higher rate, then you're making money, as long as you do so understanding that it cuts both ways. But in order to do that, usually you're borrowing money from a third party. And when you're borrowing money from a third party, they want to know more about you. And that's the essence of today's podcast.
Yes, and there's several companies out there, but today we've invited the marketing director from Checkmyfile.com, and that's Richard Catlin. Right. And Richard is a man who really knows the details behind the data, and he's going to share some of those with us today. So why don't we head on and then have a listen to that conversation.
Okay.
Richard, a warm welcome to Wealth Talk today.
Thank you, Chris. Nice to meet you.
Yeah, no, it's really good to have you on. Looking forward to the conversation today. I think it's an area that we're going to provide a lot of insight to our listeners. And the topic today is really around your credit score, but understanding the data behind it. And we know that, consumer awareness of credit ratings has been on the increase, and the important role that they can play. And, much of that is centered around what we know is credit scores. But as you'll be sharing with us today, the number itself doesn't necessarily give the full story. So before we dive into that, perhaps it'd be useful for people to understand, your role within the company.
So at Checkmyfile, we've been involved in credit scoring. It's been our lives for over 20 years now, and I'm proud to say that I've been a part of that for almost all of it. I was not quite first through the door, but I was one of the first recruits here. We were the first company to put credit scores online in the UK. We've kind of evolved since then. I've managed to work my way through, and now I'm one of 3 core directors here. But we've got a great team under us helping UK consumers really understand, the world of credit scoring, what it means for them. Because as a nation, we love credit, we really do, and so it's increasingly playing a big part in our day-to-day lives.
And today we're going to dig deeper on the distinction between, where the credit score is used directly for a decision and where it's given as a kind of easy to understand indication of credit worthiness. So I think let's begin at the beginning, and let's just maybe if you can break down, what is a credit score?
So, credit scores generally, they get a bit of a bad rap, I think, but as a thing, credit scoring is a positive. And we should all look at it like that, because what it's designed to do is help lenders make better decisions, more responsible decisions. And what that translates to then is that by taking on better customers and more appropriate customers, the cost of credit for all of us is kept down, because it means that they're taking on less risk, less bad debt. Because you can imagine that if lenders took on anybody, in amongst that, there would inevitably be people who default and don't pay it back. And so the cost of lending would have to increase as a result. So by being more responsible, it keeps that cost down in terms of APRs, if you want to keep it simple. And over the years, credit scoring itself has been proven to be better than humans. It's better. It makes more informed decisions and fairer decisions than a typical bank manager, as you might have looked at him sort of 20, 30 years ago, when it was literally a person with a form and a piece of paper, and they very often knew you as a person, but it's less subjective. So I think it's more scientific. It's proven to be good, and really, if it's done properly, we should embrace credit scoring as a positive thing.
And everyone in the UK, at what point do you get a credit score?
So again, it comes down to whether you get a number or not. So realistically, once you become 18, you can become credit active. You're allowed to apply for your first phone, your first proper card that isn't one that you got when you were 12. So really, you become credit active at 18, and then it'll vary from person to person as to what happens then. Lots of people might go to university, get their first overdraft, for example, and straight away you're building history then, which is what it's all about. You start to establish who you are as a borrower, and as we'll probably touch on in a moment, that starts to establish how you'll be viewed in the future, because the past is generally a very strong indicator to the future in terms of how you behave.
Now, some of our listeners, they might be familiar already with the names Equifax, Experian, TransUnion, Crediva is another one. So what's the relationship between Checkmyfile and those names?
So we're very unique in the UK in that we have a direct relationship with each of the agencies in the UK. So there's Equifax, Experian, and TransUnion who share credit account information. So that includes everything about how you pay your bills, your mortgage, your phone, all those things. And then Crediva, who are probably a less known agency, but still hold important information about who you are. They share information on the electoral roll, for example, and they have bits and pieces that aren't included elsewhere. So we take direct data directly from each of those agencies, assimilate it, put it all together into the same format, and show you as a consumer what it looks like. You can go and get them all separately, obviously, but each of those agencies shows it in a different format. They'll use their own score, that magic number that we're talking about now. So really, if you went away and got each of them separately, you'd see different sets of data, different numbers, and you might not know how each one compares to them. So that's our whole purpose, really, is to show you it easy to understand in one place, line by line. How do I look, and what does it really mean?
And the reports that you provide are very extensive. They're very visual, they're very nice and clear. And clearly, you as a company have focused a lot of time on presenting that data in an easy to understand way.
It's a huge thing for us, because we know from experience that credit files, credit reports, whatever we want to call them, there's a huge amount of data in there. It can be a bit overwhelming, really. You look at it, if you look at a statutory file, for example, which is what existed before we do it, it's a printout, and it looks like binary code. It's full of ones and zeros, and you have to reference tables to find out what a D or a U, whatever it might mean. And so a lot of it was kind of demystifying it, putting it in layman's terms for people to understand, and really making it digestible and less scary. People typically have this kind of view that if I stick my head in the sand, it might all be okay, and bad things will go away. And it's the opposite. It's about embracing it, logging in, and we constantly get feedback that people say, wow, this is really like a light bulb moment. I've seen the data for myself, and I actually understand what it really means. And that's hugely important for us.
Yeah, so let's start digging into that then, Richard, and actually look at why it's important to understand the data behind your credit score and what the lenders are actually looking for. So, where should we begin there?
So I think you're going to be judged really on all sorts of stuff. As I said, it could be insurance. It goes from something like that, something as small as paying your insurance monthly on your car or your home, through to actually getting your own home and getting a mortgage. Lenders, as I said, lenders love stability. They know that if you're stable and you pay your bills each month, then there's a good chance you're going to do that going forward as well, because ultimately they care about what sort of borrower you're going to be for them. They want you to pay your bills back. So really, as a consumer, you have to understand that what you've done in the past will be visible. Typically, accounts would stay on there for, say, 6 years, and then they would drop off automatically. So it's quite a long time that the information is going to be visible and be used by lenders. They operate a system called reciprocity, which means that when they share information, then they can take information. So not just any old company out there can access information about you and judge you on it. They have to be part of this system where they put something in and they can get something out. So a lender doesn't have to have had a relationship with you personally in the past to make a decision. They can use, you can use specific examples that Barclaycard, for example, might judge you on how you might have paid your American Express card in the past. So they're looking at that, and they're constantly assessing what sort of borrower you might be. And each lender has different appetites. Not all companies out there want you to be squeaky clean and have a perfect record, because there's clearly markets for those people who may not have managed to pay their bills so much in the past. And so there's companies out there designed to meet their needs. So really it's about demonstrating what sort of borrower you are and what sort of borrower that lender is looking for. It's matching the two together.
And I think certainly perhaps people at the earlier stage of their sort of wealth building career or in the younger years, might think that because they haven't had credit cards, because they haven't had debt, all of these things are good. But actually, you perhaps want some of those elements to build up your credit rating. Yeah,
it's typical. We would typically call it a thin file. So it's one where you might be registered in the electoral roll, but other than that, you've managed your money really, really well. You think, well, I've never had to borrow. I've lived within my means. I've used cash. But there comes a point for everybody really where you have to borrow. And a house is a great example for that. It always is, where you look at a mortgage. People look at mortgages very differently, I suppose, to short-term finance, cards for purchasing TVs or whatever it may be, and each to their own in terms of that. That's totally fine. But if you are looking to use credit in the future in the form of a mortgage, it is going to be a case that you need to establish a credit history. And that doesn't have to be horrible. That can literally be a card that you keep separately. You might use it for petrol purchases or shopping. You clear the balance in full every month. You know that it's not hanging over you, and you're not going to get into difficulties. But at the same time, over that period, you're building your credit history and you're demonstrating that you are a good borrower. So I guess it's important to take a long-term view of credit and how you use it responsibly. But ultimately, it's a good thing. I think it can be a real positive.
And, simply just looking at a number, it doesn't really tell the story. So even someone who might be on a 999 or full green bar, that doesn't really, what does that really mean?
The number's there just to make it digestible, really. We show a credit score on Checkmyfile. We call your Checkmyfile credit score. So we take all of that information and we interpret it as to how we think a typical lender would look at you. And each of them, each agency or each company that shows you that information is trying to do the same, but lots of them will use a different scale. So you might see 250 to 750 or 0 to 1,000, and they can be all over the place. And really, it's just a guide. You should use it as have a look, see what it is. But what you really need to do is just dig into that data. At the end of the day, it's your information that somebody else has collected and shared and has been put together. And so you really are the only one who knows what that should look like. So did you really miss that late payment, or did you really open that account, or are you really related to that person? Only you know the answers to those questions, and the data is where that lives. And so by really looking at it, going through it carefully, you can make sure that everything is as it should be, and that it's a fair portrayal of you as a borrower and as a person, because otherwise it will just stay there. Unless you challenge that information, it will just stay the same until it falls off. So by checking the actual data itself, you can make sure it's all correct. And should you come across something, you can do something about it. I mean, I think we'll come to that in a moment, but errors do happen occasionally, and you won't see those errors in the score. You'll only see the errors in the data.
Yeah, and do all the agencies update every 30 days? Is that a regular pulse for them?
It depends on the relationship they have with the lender or the organization. So some organizations might pass information more frequently. Typically, every month is when it will go across. So in the olden days, it was literally a tape that went across to an agency and was uploaded. Now, technology being what it is, the information can come across much faster, much easier. But yeah, it'll go across. Those relationships differ as well, which is key. I think with Checkmyfile as well, you'll see that if you looked at your full file, you would see that you might have your mortgage, for example, it might be reported slightly differently because not all of them have updated. So you might see that one of them would show what you know to be your most recent balance, and another one might be slightly later in updating the information. So the balance might reflect, say, one less repayment. Differences will occur according to how the information has come across and the speed at which it's been updated.
So let's look at why it's important to be regularly looking, and hence why the Checkmyfile report is so good, because it makes it so easy to check for these errors. So a lot of our listeners are property professionals, Richard. They're building their wealth, they're business owners. So, it's important for them to make sure that, their credit is in the, in the order it needs to be. And especially timing, right? Because they might be applying for mortgages or remortgages and things like that. So how do you go about checking for errors? What are some of the tips perhaps that you might have for them?
I think, your audience is a great example of why it's so important, because a mortgage lender, they want to know everything they possibly can about you and your past. So of those agencies that are there, the three agencies that are going to be reporting account information, a mortgage lender would typically go to 2 or 3 of those and look at the information that's there. So if you only checked one, for example, say you only go and check Equifax, and the mortgage lender you go to, that they check all 3, there's a chance that there could be information that's different at the other 2 that you've not checked yourself, that they'll see, but you won't see. So you think but you only know part of the picture. So it's really important that you, like I said, go right through all of the agencies, see what each of them is reporting, and make sure that everything is correct everywhere. Because otherwise, you could find a nasty surprise somewhere. And you certainly don't want that if you're in the property business. It could come down to things like the electoral roll, for example. Each of them is updated separately. So you want to make sure that you're recorded at each of the agencies on the electoral roll.
Okay. And if someone were to find an error, how can you go about helping them with that?
It depends what it is, to be honest. Lots of it would relate on, you would look at it, and if there was something relating to a particular lender, the going to the lender is often the first port of call. You could speak to them, let them know that you've checked it and it's incorrect. And if they can agree that, yes, it's been an error, they can contact the agency on your behalf and get it changed. If they disagreed, or you kind of run into a bit of a brick wall, that can become a bit frustrating, overwhelming. Credit files are very emotional things. So what we do there is that we would have a team here, a disputes team that liaises with our kind of corresponding teams at each of the agencies, and we'd simply send the information across, let them know what's wrong and why, and then liaise with the customer as we go through the process of getting it updated and fixed. And that can vary. It can be things that are a late payment that was recorded incorrectly. It could be missing information. Associations are a great one. And sometimes it can come down to the intricacies of reports and how they work. Twins always a great example of this, I think, where if you're a twin, you obviously share a date of birth with your sibling. And parents often have this very annoying habit of giving their children the different names with the same initial. So you might have twins and you call them John and James. And you can imagine then that 20 years later, they might be Mr. J. Smith. They're both there as Mr. J. Smith with the same date of birth. They've both lived at the same address that they grew up. And so there's all these links. And so to a lender, you can imagine that it's not improbable that their data could suddenly become a bit mixed up. Unpicking that can be quite challenging. But again, only by digging in could you find that. That would be something we could certainly help with. I mean, you can imagine that twins, they're not the majority, but errors like that are a good example of why you need that expert help from time to time, I think.
You mentioned associations there, and also consistency, right? So perhaps if you've moved address a few times, or you might live in a flat and there's just a different way of spelling the number and the house number, little things like that could affect, lenders giving you the right decision.
They do. So addresses, I think we find Scottish addresses in particular, they have certain formats that they operate. So you might be upper flat left or flat B, and you might not think anything of it. You might think, well, they use both versions and it's fine. But there are systems in place where lenders try their very best to try and find that information. But you just need to be really consistent. So whether that's your address, or if you change your name, you might get married, for example, and take a new surname and use 2 different versions. It's quite possible that a lender might only bring back, say, some of your data. And that can be as frustrating for them as it is for you, because they want to see as much as they can. Associations are another great example where I love this analogy, that just because a relationship ends, your association doesn't. So you can imagine that you go for a mortgage and all of a sudden an ex-partner from 10 years ago is the thing that perhaps stops you getting that. Not only is it frustrating that you don't get the mortgage you want, but it can lead to some really quite awkward conversations at home with your new partner as to why your ex from a long time ago is still lurking there and causing these difficulties. So it's not a problem. It's not a hard thing to get changed because you don't hold a financial link with them anymore. You don't hold accounts with them anymore. But it's frustrating and can be embarrassing as well.
And I guess another aspect is just being clear as to the timings of when certain things are going to come on or drop off your report and how that might affect things.
Oh, absolutely. Yeah. Like information stays on there for very fixed periods. It's quite linear. It's quite clean in terms of when stuff goes on and when stuff should come off. But if you're planning ahead of time, if you know that you're going to be applying for a mortgage in, say, 6 months' time, and you can see that there might be something adverse on there that would come off in 7 months' time, you'd be crazy if you applied while it was still there, just waiting that little while until you know something that's likely to change. But crucially there is absolutely verify that it has come off, because whilst it's expected to come off in, say, March 2022, don't rely on it. Check the data for yourself, make sure that that's happened. And then if it's at all possible, time your applications for finance around that to make sure it's there. And it can work the other way as well, like we touched on at the start. If you had a thin file, you want to wait 6-12 months before you're making applications, because if you apply for a card and then apply for a mortgage, you've built no history. All you've got is an application and 1 month of repaying your credit card. So using those things to your advantage, making sure that you time applications so they fit in with what your file actually looks like and the information you're going to be judged on, and you'll stand a much, much better chance of being approved.
And that's a great tip there. So I guess to conclude then, Richard, is there anything that we've not covered which you think is important for people to understand? And perhaps, just to summarise best practice for anyone who wants to keep a good check on their credit?
I think for us, different people will check with different frequencies, and we embrace that completely. We make it easy for people to sign up, but crucially, it's easier to cancel for us. So you have a free trial, you can come in and see what's held about you. And we love to build these long-term relationships with our customers. But some people will check routinely every single month and make sure that everything's fine. Other people dip in maybe once a quarter, but it really fits your needs. And I think, it may be that a lot of your listeners fall into the kind of the formal one where they're regularly moving properties around and applying for lots of different products. It may be that that's crucial for them to stay on top of the information, but really finding that frequency that fits your lifestyle and your borrowing patterns, that's really, really important. Like I said, we embrace it. We've got customers that have been with us for almost as long as I've worked here, and we've got other ones that dip in and we see them again a few years later. That's great. But really, I think only by understanding that it's your information and, it's your data, you need to just embrace it, check it, and really understand what's there. And then if you do need a helping hand, then we're here to do it. If you're more financially savvy, like a lot of your listeners, then I'm sure they'll be able to take that action themselves. But it's really seeing the data, being able to act on it, and adjusting it according to your own needs that's crucial, I think.
Richard, if anyone listening right now wants to go and check out one of those reports, what's the simple next step for them?
So just visit checkmyfile.com. Like I say, it's a really easy process to join. We would really hope that people would see the value, see the depth of data. If they needed to speak to one of the guys here, it's a real person on the end of the phone. They're all professionally trained credit analysts. They're not call center staff. So helping hands here if they needed to. We'd love to be able to help them progress on their journey through, especially as listeners clearly have a big need for services like yourselves and us. So we'd love to be able to build a relationship with them. But if not, then it's really easy to cancel that trial, and we'll see them at some point in the future.
Great. Richard, thanks so much for sharing with us today.
No, thanks for your time, and best wishes for the future with the podcast.
Thank you.
Okay, thanks very much.
Okay, so thank you to Richard there for sharing his insights around the world of credit scoring.
Yeah.
Before we take a look at some of those in a bit more detail, Kevin, let's head on over to Trustpilot and have a flick through some of the latest reviews, and one that's caught my eye this week is from Michael. And Michael says, a bright star in the murky world of financial advice. So the world of financial management advice is full of individuals and businesses offering advice. The problem is a large number do not have the depth of skills and expertise to add real value despite taking a fee to do so. Thankfully, there is a bright star in this industry, and that's WealthBuilders. So from the first phone inquiry, their support to me has been targeted, thorough and professional. 18 months after hearing about SaaS for the first time, I now have mine set up and a clear strategy as to how to make the best of it. Both Kevin and Paul have worked hard to guide me on the journey, avoid pitfalls, and ensure they understand what I am trying to achieve. An impressive outfit.
There you go. Bright stars. Well, we've got to pay attention to the stars, but we also got to pay attention to our credit score, Chris.
We have got to look at our data.
Yeah.
So what did we learn from that? Well, we learned obviously that errors can occur.
Yeah.
And if you don't keep a check on that, then those errors could, crop up and cause problems. And especially if you're, in the world of property, like many of our members are.
Yeah.
Just by going through, making sure that, addresses, perhaps if you've been moving home recently, that things have been updated. And, I've seen that myself, when I moved away and went to Portugal a few years ago, changed some addresses and, a couple of those things needed to be checked on. So, and also I share the same name pretty much with my father. So,
okay.
I did once see his name pop up on the report. So, these points are valid.
Yeah, well, look, anything that can help you and ease the way for you to be able to get access to the money that you want it to be smooth. So the timing is often quite an important issue around that, especially as people making a transition often from being, let's say, traditionally an employee into then working in business or working in property, which of course is the mainstay here in the UK. And many people make that transition, don't think about the need for maintaining that employability, for example, to be able to get mortgages. And they create limited companies which have less of a track record, so the timing can be really very important around that. So yeah, getting the information right, absolutely. Checking your file, definitely, like so many things we ask people to check. In the debit section, checking whether they own their home as joint tenants, as tenants in common, checking that they've nominated their spouse or loved one as a beneficiary of their life cover, or indeed their pension at work. So lots of things need checking, and it's an important part of being a good wealth builder to keep an eye on things, because if they go wrong, you almost always get knocked off balance because you can't recover in time to do what you originally wanted by the time you get these errors or mistakes corrected.
Absolutely. And, I'd recommend everyone listening to head to checkmyfile.com and you can try it free for 30 days. It really, really is a very good site. It gives you a very good report of everything. So go and check it out and just make sure everything's, as it should be. And then it gives you the peace of mind, to continue building your wealth.
Mm-hmm.
Good. Okay. Well, I think that sums everything up today. I think Richard covered all the key points there. So we'll catch you same time, same place next week. Until then.
Yes, but we probably won't be together then. So until I don't know where you'll be and I don't know where I'll be. But until then, Chris, my friend, I'll see you.
We hope you enjoyed today's episode. Don't forget that we are constantly updating our resources inside the WealthBuilders membership site to help you create, build and protect your wealth. Head over to wealthbuilders.co.uk/membership right now for free access. That's wealthbuilders.co.uk/membership.